Good afternoon, everybody. This is Mike Berry with Quorum Private Wealth, and you are attending a webinar that we're doing as part of the Quorum Forum, which is a quarterly broadcast that we do with what we consider some of the smartest minds in the investment world. These are typically done with a format where we do it like a fireside chat. If you have a question that you would like to ask our speaker, there's a tab at the bottom of your screen to put it into the chat. Please put your question in there and we will either address it during our discussion. I'll integrate it into the Q&A that I have with our guest, or we'll ask it at the end of the discussion as well. If your question is not answered by the end, we'll follow up with you directly on it. And this particular session is going to be recorded, and so we'll have this for replay, and we'll send that out to you at your request, and we'll be making it available to our clients if they like. For your best view, there's also the speaker view setting for Zoom that you can tab into and set it up so that either whoever is speaking comes up on screen, or have it set up so that everyone's on screen at once. Whatever is your preference, go ahead and feel free to make those changes. Well, our guest speaker today is Marianne Bartels. Marianne Bartels is someone who's very familiar to me and my cohorts here at Quorum Private Wealth, who all came from Merrill Lynch. In the 30 years that I was at Merrill, most of those years, Marianne was there as well. And I got to tell you, she was probably one of the biggest influences on how we approached our investment philosophy and set the themes of the investments that we did. Marianne is a multi-year analyst all-star, has been highly acclaimed in many ways. She appears on everything from Bloomberg to CNBC, has been in every financial publication such as Barron's, Forbes, you name it, and is synonymous with being one of the best and brightest minds on Wall Street. And one of the things that is always most memorable about you, Marianne, is we would do our annual recognition retreats at Merrill nationally with all the top Merrill Lynch employees from around the country. And the highlight of that was generally for me when Marianne presented to the whole group, because she would give her themes of what she thought maybe coming up in the year ahead or in the decade ahead, and would always do it in a very dramatic and entertaining way. And it was not only entertaining and dramatic, but it was so highly intelligent that everyone walked out of the room thinking, oh, I got it. Whenever I would bring my wife to these meetings, she would want nothing to do with, anything, corporate, or whatnot. She would go off doing anything except the first thing she'd always ask, when is Marianne Bartels speaking? And she would always attend those meetings, and it was wonderful. So, Marianne, welcome to the Quorum Forum.
Thank you.
A moment first to tell everyone a little bit about your background and why you're here. And then I'm going to start a conversation with you with some great questions.
Well, I'm not one of those people that, at a tender age, looked at the Wall Street Journal and stocks and wanted to invest and go to Wall Street. I was more theater, acting, dancing, singing, more presenting. And that's what I wanted to do. And my parents told me I had a brain and I had to go to college. And my dad's baby sister, who also wanted to be an actress on Broadway, tiptoed to Wall Street in 1956 because her uncle found her a job after she graduated from college. She had worked on the floor of the exchange, and not a place where she thought that she would wind up, but she did. She was the first woman on the trading floor at Ladenburg Thalmann in 1956. And she thought she would do it for about a year, and she retired at 80. She had her own newsletter. If you ever watch the program Wall Street Week with Louis Rukeyser, she was on that program for 25 years, and she was one of the elves. She's also one of the co-founders of what's known today as the CFA Institute. And she ran almost every financial organization on Wall Street. And when I was a young girl, I would go visit her in New York City because she lived in the city, and she would take me out, for a nice fancy lunch or dinner. And somewhere in the conversation, finances came up. She would always say, "Mary Ann, you're a woman. I want you to understand finance." And I wound up going to college, and I, believe it or not, majored in economics. But I never wanted to lean in on my aunt because I wanted to do things on my own. But she always offered for me to introduce me to, particularly to women on Wall Street, so I would understand some of the opportunities that were available. And it wasn't until one of my professors I was having a conversation with and mentioned that I had this aunt and how I didn't want to use her to network. And he basically called me an idiot. Nicely, though. He said, "Mary Ann, your aunt is not going to get you the job, but she'll be the gateway, the door opener. And you're so fortunate to even have that. But he said, you'll have to prove yourself." So I called her up, and it was only a couple of months from graduation. And I had a couple of job offers, but I wasn't really that interested in them. And I said, "You know how you're always asking me to meet women in the industry?" She said, "Yeah." I said, "I'd love to do that now." And she went, "Damn it." She got mad at me. She's like, "All the good jobs on Wall Street are gone because everything is done so early with the internships and programs." And this was late in the cycle. But I had the opportunity to meet some really fascinating, wonderful women. And I got very fortunate that one of them hired me. So my first job was at Manufacturers Hanover Trust in the trust department of the bank. And it was phenomenal because I had my aunt as a mentor. The person that hired me was a woman. And I learned a tremendous amount, but I found that banks were very boring, at least from my perspective, not insulting anybody that works at a bank. But I tend to be a little bit more fast paced. And I wound up going to the sell side. And I was a junior technology analyst. I actually did work in my aunt's business for a period of time. And after I graduated from Fordham University with my master's, Chuck Clow hired me at Merrill Lynch. And that's how I got to Merrill Lynch. And I did a lot of different things at Merrill Lynch. I was in strategy. I was the quant. I did trading strategies for hedge funds. I ran the technical department for 7 years. I went into the wealth management division and worked in the chief investment office for 7 years, went back to research and launched coverage. We were the first bulge bracket firm to launch ratings and coverage on exchange traded funds. And then I was exhausted and tired, and I retired. A year out of retirement was fine. After a year, I was bored. I took classes in crypto. I really thought there was something in that ecosystem of blockchain and Bitcoin, and I didn't understand anything. And I took several courses to understand it. Opened up my own consulting company, had one of the RDs at Sanctuary contact me for lunch. And the next thing I know, I'm working for Sanctuary. Yeah. And so I'm the chief investment strategist here at the firm, and I'm delighted to be here. It's an exciting time, and it's really wonderful to see many people I worked with at Merrill go independent. I really understand the business model after being in several offices, and I'm just so proud of the advisors that had the courage to, step up and start their own company. And thank you for joining them in their new company. And I'm having a great time partnering with our advisors here at Sanctuary. And we're up to just over about 75 partners right now.
Yeah. Well, like a lot of the founders of Sanctuary who were regional directors and market leaders at Merrill, they found that banks were boring too. And so they had created this firm as a sanctuary for people from Merrill and the big wirehouses to find a way to be independent and be entrepreneurial and not be part of groupthink, do things the way that they want to do it, and try to deliver for their clients. But thank you very much for that intro. And there's so much more that could be added to that too. Just to be at the lead of research for Merrill Lynch and actually run the RIC group, which is for those of you that were Merrill clients, you may have seen reports that we would send out to you, which was a collaborative of all the different research groups at Merrill, at the time the biggest in the world. Mary Ann ran all that. She was the one, and we're very proud of her and very pleased to have her here with us here as one of our resources through our affiliation with Sanctuary as a partner. And speaking of banks,
A lot going on in banks,
Right. So why wouldn't that be the first question we ask about the banking financial sector? I mean, obviously, there's a lot going on there, and a lot of this revolves around not just maybe some bad management by Silicon Valley Bank and a few others, but really what the Fed's doing and what their objectives are, and maybe how what we thought may happen has changed a little bit.
Yeah. So sometimes banks aren't really that boring, right?
Right.
So there's a lot going on, right? When we look at history, right? Because I've been in the business now for 40 years. This is not my first crisis. I've been through many crises. My first crisis was the crash of 1987. That and I was young, and that was scary. And we got through that. I remember the S&L crisis. I remember when long-term capital, the hedge fund, collapsed. Russia defaulted and took down a hedge fund that was systematic to the system. I'll never forget 2008 and 2009, the great financial crisis. The great thing about America is and capitalism is that we have a crisis and it takes us a couple of tries, but we eventually fix it, right? So we may not get it right the first time, sometimes not even the second time, but eventually we get it right, and there's cycles. And guess what's involved with most of these crises is the Fed has been raising interest rates. So very often when the Fed is raising rates, something eventually breaks. So in this case, it was Silicon Valley Bank that broke. And what happened is not what I would have ever expected. It was a traditional run on the bank. And if you ever watched A Wonderful Life, George Bailey tries to tell the community, we don't have your money here. It's in, George's house or Peter's house, right? They lend it out. So if everybody wants all their money at once, there's no bank that will have all the money. In this particular case, and Silicon Valley Bank had a very specific deposit base. Obviously, a lot of tech companies, a lot of venture capital. And as interest rates started going up, capital to new companies dried up. So they were leaning more on the money that was in the bank. So they had already started to see a pattern of money coming out of the bank. Many banks have a portfolio that they invest in with treasuries and treasury-like securities, government-like securities. And as interest rates went up, the value of that portfolio went down, right? Because there's an inverse relationship between yield and price. So when the interest rate goes up or the yield goes up, the value of the bond goes down. So they have losses in those portfolios, but they're unrealized. Eventually, when they come to maturity, they will get paid 100%. But in the period of time where they're active, there's what we call unrealized losses. So in Silicon Valley's case, what had happened is depositors wanted their money and they needed to raise capital to meet the demand. The way they needed to do it was by selling some of the bonds in the portfolio, and they had to take a loss on it. It was a $1.8 billion loss. In order to maintain their capital ratios, and banks have legal requirements to be a viable bank, they have to keep certain ratios. They wanted to go out into the market and raise capital in terms of the equity market. And the equity market wouldn't let them do that. Meanwhile, one of the venture capitalists that had a portfolio of companies saw what was going on and tweeted, "Take your money out of Silicon Bank." And literally within a day, $42 billion went out of the bank. And the next day it was going to be 100 billion. We've never seen money move this fast in a system.
Pretty good snapshot of what this little thing can do now, right?
Exactly. And the regulators haven't caught up to all of this. In addition to that pattern, when you really look at how the bank was run for risk, they really would get an F, right? There's a management F there. There's the deposit base that wants their money. The other problem is with the regulators, because the laws were changed in 2018. For banks under 200 billion, they were no longer required an annual stress test. Now, it gets a little bit more convoluted than that. And what I'm about to say is a little bit mind-blowing. But part of the stress test, even if they were stress tests, was not for a higher interest rate environment. So they may or may not have caught it. So a lot of can of worms have kind of come out. the good news is we have a partial solution to this, right? So we got good news yesterday that part of the Silicon Valley Bank portfolio, the loan or deposits, is being sold to Citizens Bank shares. What they didn't take is probably all the stuff that doesn't have really a good value to it. So there's still a sizable amount that the FDIC has on its balance sheet that it has to resolve. But Wall Street, Wall Street's, there's a few sharks. And whenever they sniff out, something's not working, something's bleeding, they want to find the next one to go. And the other bank they started to attack was First Republic Bank, another California bank. And part of the fear here is obviously that deposits are insured up to $250,000 only. And many businesses that are doing payroll have a lot more money than $250,000. So there was also a panic where money started coming out of these other banks and going to larger banks where they would have more insurance. And so that started to stress First Republic. But the temporary solution is there's 10 banks that actually gave money back to First Republic. So they're fine for now, but there's probably a solution that we still need for First Republic. So we're not through this crisis yet. It has ebbed and slowed down, but it's not fixed yet. So we've been saying that there's going to be more volatility. Now, the Fed recently had its press conference, and Chair Powell raised rates by 25% and has indicated they'd like to raise rates another 25%. They have not, their tone was a little bit softer. Prior to the banking crisis, it was anticipated they would raise rates 50 basis points. So they did come down in the amount of rate hike that was originally anticipated. Their tone was a little bit more dovish, a little bit softer, but they have left it on the table that they could raise rates again, but acknowledge the banking crisis and acknowledge that credit conditions are probably going to tighten after this crisis. What does that mean? Banks are not going to give out loans at the rate they were giving out loans to individuals and to businesses, and that slows down the economy. I've heard, the Fed itself said that this can impact the economy, slow down the economy. They don't know by how much. They'll be data dependent. I've heard many people say it's like a 25 to 50 basis point additional rate hike in terms of tightening. But the Fed also did something else with the FDIC. They've opened up a loan facility where banks that have these losses in their bonds can go to this loan facility, and let's say it's 80 cents on the dollar, they can get 100%, they get a full dollar and bring it on their balance sheet. So what's happening is the Fed's balance sheet is growing again. So they've done all this tightening by letting bonds drift off their balance sheet, but now they put all these bonds back on their balance sheet. Now, this is not exactly quantitative easing in the sense that the Fed's intention is to lower rates and keep rates down. Quantitative easing is a deliberate act to push interest rates down, to keep interest rates down, and create a risk behavior in terms of investing. This action, by putting the bonds on the portfolio, is what we would call like a traditional monetary liquidity providing. It's a form of easing, but not in the sense of trying to create risk or lower interest rates.
Take stress off the bank, but doesn't necessarily put it into the system.
Correct. Well, some of it can go into the system.
If it's lent out. Right?
It can, but it's not the intention to manipulate the direction of interest rates. That's the key part. And they really don't want a lot of risk taking.
Right. Crises like this is usually started by some type of black swan. And what's interesting to me is that the Fed's intention with raising rates was trying to put a squash on employment, because unemployment's been so strong. And it's the only real leading indicator that hasn't had cracks in it along the way over the last year. I mean, last year we had 2 instances or 2 quarters in a row that we had negative GDP. We had many of the other sectors of the economy that the Fed watches that had down to negative ticks. but unemployment was so strong. So in trying to temper unemployment and try to move it up to say 4 to 5% from the low threes from where it is now, they kept raising rates. Well, they ended up doing something else and creating it's not a total exogenous event or systemic event, but they broke some banks. And as you've mentioned, this actually will probably tighten liquidity to the consumer side, and in effect, do additional rate hikes without them actually having to raise them. And in some instances, it appears to me that the Fed, is banking on having interest rates at a certain level before they stop. One, to obviously slow down inflation, which is really important, and that's why we have the Fed. But they need ammo. I mean, think about a year and a half, 2 years ago, we were at 0 interest rates. If the economy had gone into a recession or if it had a major slowdown, they need that ammo of being able to lower interest rates in order to stimulate. Now, whether they stop here at 5% or if they continue on to 5.25%, 5.5%, 6%, it's going to hurt us as consumers. It's going to not be good for financial markets in the near term. It gives them that much more when we do eventually lead into another recession, which will happen. That's part of the business cycle, right?
That's correct. And that's why the Fed wants to be able to continue to raise rates, because inflation measures have rolled over and wages, which is a leading indicator of inflation, have rolled over, but inflation levels still remain very elevated. And Chair Powell keeps the book of Volcker on his desk. And the title of that book is Keeping at It. And he used that term in his Jackson Hole speech several times, because he does not want to repeat the inflation problem of the 1970s, where inflation gets so embedded into the economy, takes extraordinarily high interest rates in order to get inflation down. They would rather, temper employment, go into a recession, preferably a soft landing, not a hard landing, to just get inflation to a point where it meets their target, which is 2%.
Yeah.
And
oh, sorry.
No, and I feel if we look at CPI, it does look like it's rolled over, but nothing moves in a straight line, right? It can be a little bit bumpy and jaggy. So markets really can jump around those numbers. The other thing is right now, there's a big mismatch between what the market thinks the Fed's going to do and what the Fed is telling you that they're going to do. And that can create volatility. The market is already looking for 100 basis points of rate cuts starting in May.
Right.
And we keep going through the cycle back and forth, rate cuts, no rate cuts, rate cuts, no rate cuts. And it creates all this volatility in the bond market and the stock market. So we're telling people to have quality in their portfolio, to be a little bit more balanced. But hey, if you can get 4 or 5% in a treasury, which is considered risk-free, that's quite an attractive investment in the near term.
And it's about time. We've waited a long time to be able to make money on bonds like that, which is good. And speaking of inflation and interest rates, usually in inflationary periods, hard assets like real estate usually do pretty well. So we're based out of Northern California. A lot of our clients are through metropolitan areas around the country. Commercial real estate has been a question mark. There's certain sectors of it that are doing extremely well, like multifamily, some of the industrial and warehouse space. But office space is very dicey. It depends on which market you're in. Here in San Francisco, it's been very, very difficult. But other areas such as Miami and parts of Texas are actually doing fine. Where do you see the impact coming, the impacts on commercial real estate with what's going on with not just the banking crisis, but with how the Fed's acting here?
Right. Well, a lot of the commercial real estate problem stemmed from COVID, right? Working from home and people not wanting to go back into the office. You can see I'm at home.
Right.
I
think that's changing, and some of the layoffs and stuff that are coming are kind of focused on those people that won't come back.
They're trying. They're certainly trying. But there is an impairment on the commercial side, and even talking to some private equity firms that internally our alts person has talked to some of the private equity people. The market is looking for a contraction in commercial real estate, but you have to know what pocket, right? Not all commercial real estate is exactly the same. And when you look at the impairment that they're projecting, and look at it as a percentage of the whole real estate pie, it's only, let's say, 3 to 5%. So it's believed that it can be digested within the system, but this is what I can tell you. Anytime you have defaults and people start talking about it and you see multiple defaults, it will create volatility, even if it's a small percentage.
Sure. But also create opportunity for the next person to come in and buy it, and in the next cycle they end up making money on it again, right?
That's the cycle. And
Right.
and the key to surviving higher interest rates is not being highly levered, right? And there's always concern if you've had a mortgage and it was an adjustable rate mortgage and it's going to get adjusted higher, right? So it's about knowing where those pockets are. And as you said, we go through these waves all the time. The S&L crisis was really a real estate crisis.
Right. That's true.
Yeah, that was mortgages.
Yeah, as was the great financial crisis. But it's very different this time, and so we're not suggesting to clients at all that this has any similarity with what happened in 2000.
This is not a credit crisis. This is a liquidity issue with a mismatch with assets and liabilities.
Right, and some bad management with that bank. Well, talking about commercial real estate, those are assets that people own. In the active asset management that we do with clients, we're fairly institutional in how we approach it. We're asset allocators. We place our clients typically in a portfolio mix between stocks, bonds, and alternatives. Last year, one of the things that helped us quite a bit was having alternative investment exposure in our clients' portfolios. But for the most part, the liquid part of our clients' portfolios has fallen within, somewhere in a range of the 60-40 portfolio balance, where it's 60% stocks, 40% bonds, some people are 70% stocks, 30% bonds, so on and so forth. And then we add on alternatives in there also. There's been talk over the last year that more than last year and a half, that the 60-40 portfolio is dead. That doesn't work anymore. You can't have that mindset. That's the thing of the past. Kind of reminds me of some of the talk that I heard back in the .com era, where the old way of thinking doesn't work. And we sure learned that was wrong. We still believe in it, but what are your thoughts on it? Is the 60-40 dead or alive?
No, so we've written 60-40 is back. 60-40 is back and alive. And I think you have to look at rates in two different buckets. Our view, this is our personal view, not everybody agrees with us. In the very near term, interest rates, because they've dropped so much on the front end and the back end of the curve, they can back up a little bit, which means they can go up a little bit.
Which we've seen.
I'm still expecting the trend is for them to come back down, especially if we have a recession. Mm-hmm. And I actually wrote in our year ahead in December that I thought eventually the 10-year will get back down to 2.5%. But there is a regime change. Rates peaked in 80 and bottomed in 21. That cycle is done. We're moving into an interest rate environment again. We're going to have rates. We're moving into a more inflationary type of economy, not a deflationary economy, more inflation. And part of that, there's a few reasons why. We realized during COVID that we had too much supply outside of the United States. So we want to bring that supply onshore or near shore. That there's a cost factor to that. So there's things in the economy that will keep inflation somewhat in the system, not deflationary, but in the system. If we're correct about that, once you get rates down, I think they're going to go back up again. So it's not that you don't want to have fixed income in your portfolio. It's about how you manage that fixed income in your portfolio. And it's about the duration and it's about laddering, right? So I think right now, personally, you can have longer duration. Not the recommendation from our investment counsel. The investment counsel still has a shorter maturity, but I'm willing to take that risk and go out a little bit longer because I do think rates are going to drop down to 2.5%. But if we go there, then I think it's time to bring duration back in again and to do a lot of laddering in the portfolio. So what is laddering? Laddering is when you buy paper, fixed income, at various different maturities. So you always have something maturing and you're rolling over. So if the interest rate environment does go up, you're able to participate in that. And there's no reason why you can't have a 60-40 portfolio. It's about understanding how to manage the portfolio. But it was beautiful and easy to do it from 1980 to 2022, because interest rates were in a secular decline. You really didn't have to think about it, and you could hold long maturities. That may not be the case. We don't think that's going to be the case going forward, but it doesn't mean that you don't want to have that in your portfolio.
That's right. Okay, well, what do you think about adding alternative investments into a portfolio? You know, we use everything from a private REIT to direct investment in private equity, private credit, different factors. It seems to me that private credit actually might be in a pretty good position here with what's going on with the banks. As far as being a good alternative lender for a lot of corporations, and they'll be in the driver's seat as far as creating the terms for those deals, and with less competition from the banks.
Right. So the private market for private credit was able to really grow and evolve after the great financial crisis, where the banks couldn't do a certain type of lending anymore. So there is a market for private credit. In terms of being able to invest in real estate, you know, pension funds, endowments have been in the private market for a long time, and but they weren't sensitive to liquidity. They were able to lock up their money for 3 to 7 years. The average individual, first of all, most people don't want to lock up their money for that long, and they didn't have vehicles where the individual investor could even get access to real estate in the private market. But now the market has created investment vehicles where they call it the democratization of the private markets, where individual investors can actually get access to the private market. And most individual investors really don't have a lot of exposure. And we're really seeing the demand grow over time. And we believe that investing in private equity will continue to grow over the next few years.
Yeah, the democratization of that sometimes, you know, can be a signal that maybe there's risk there. If you look at when the trend of individual investors learning how to speculate on online investing, for example, you know, the old E-Trade commercials, if you remember that, where it's like, you don't need anyone else to do this, you do it yourself. And then people started doing it on their own, and they started stepping into waters they weren't as familiar with. Even though many of our clients and people we know are great investors on their own, there's a lot that aren't, and make those mistakes. And, you know, I think there's some concern that the democratization of private investments could be a risk, but I look at it in the viewpoint that there's so many fewer listed stocks on the market and other investment vehicles that have basically moved to the private markets.
That's correct.
It's the same dollars, just being held in a different way, in a different style of investment that has actually become a lot friendlier to hold, since a lot of these items are now not strictly K1 or qualified purchase or direct limited partner direct investment. It's a 1099 type of structure. Right.
And that's correct. So it's really a way to get access to investments that traditionally an individual investor could not have access to. That's correct.
So along with rates that had gone through this big cycle from the 80s down to now, and then with some of the happenings since 2020 with COVID and coming out and different things going on around the world, we've seen the dollar move to an all-time peak, and it's been very strong. That's kind of turned over a bit. And we look at our investments generally on a valuation basis. Like it's a sector that we're in overvalued at this time. International stocks, international investing has been something that's been attractive to us several times over the last couple of decades. And most of the times, whenever we decided to step in those waters, we found that it just continued to be even more of a value afterwards, because it just didn't go anywhere. Some of that was really, relevant to what the dollar was doing, but some of it was also relevant to other factors going on in those economies. how do you feel right now about international versus domestic investing? Because I think just like with alternative investments where most people are either not exposed or completely underweight in, I think our international exposure has become extremely thin over the last couple of years. And is it something that we should start reconsidering?
So we like the international markets. And obviously, when the US has a cold, foreign markets catch the flu. So everybody's been hit during this crisis, but the valuations are very, very attractive overseas. I don't think the dollar is going to go up a tremendous amount more, because as the dollar goes up, it can detract from your return. I think this is one of the best times. And let me say this, there are times you want to be in international and there's times you really don't want to be in international. I think this is now a time you want to tip your toe into the international markets, because when we're looking at the price behavior of our markets relative to international markets, we don't actually look as strong. And that's because we're just so expensive. Even though we had the bear market of last year, valuations in some of the big cap names just haven't come down enough. So I still think there's pockets of the market that are still going to be under what we call PE compression. And tech here in the United States is a much larger part of our market. International markets don't have a lot of tech. They have more, banking, more value, energy, and those prices are extremely now depressed. So right now, I think you can start tiptoeing into the international markets.
Would you say an emphasis on value here domestically would still make more sense? Since
I would argue balance, because banks are value. They're a big component in there. Yeah. Energy is a big component. I'm more confident in energy, and I'm more confident, in energy versus where banks are. But let me say this. At some point, banks are going to be a very strong buy.
Right.
It's when you're in a middle of, and I don't like really calling this a crisis, but we're all calling it a crisis. It feels more like a panic. I don't feel it's resolved. So there could be another shoe that drops that flushes this out. And it's like catching a falling knife. Traders can do that. Traders can start building a position. Some of the best traders I know will tip in and they'll take a little bit and they'll expect it to go down and they'll buy a little bit more and they'll expect it. But, that's dollar cost averaging, but you're chasing it on the way down. I'd rather see it kind of flush out and hit a bottom and have a little bit more confidence. But when banks trade, we look at price to book. When they start trading below book value,
right,
they're attractive. And we're seeing that in big banks and small banks. So from a pure valuation standpoint, banks were already attractive from a valuation standpoint. Now they're really attractive. So eventually I think value will come back, but I think having a balance between growth and value as we're having this transition with tech and this transition with financials is probably going to work out a little bit better in your portfolio.
Well, as you were saying, you think that you might see, rates on the long end of the curve contract and then eventually come back up. And that coming back up, I would think is what you're saying is a normalization of the yield curve, where you have lower rates on the short end and then it starts going up in a normal incline instead of being down now how it is, which is hard for banks. It's actually was the issue with Silicon Valley Bank. They were just on the wrong side of the yield curve. They positioned themselves incorrectly. So the yield curve going down the way it did, or inverting the way it did, that's what really messed them up on that part of their portfolio. So, and I totally agree and see that. So that being said, and you're welcome to ask your business
my little plug here
for their opinion on this. So what's next? I mean, one of the things that I've always admired about you is your thought out in the future on certain trends, some paradigm shift that's going to happen, or something that no one is talking about or looking at right now that is out there on the horizon. If you don't have it on the tip of your tongue, that's fine. But I was just thinking, you usually have at least one or two things that we're not thinking about. I'm always an optimist. For example, you were talking about when you started right in the beginning of or in the 80s, just before the stock market crash in 1987. I started in June of 1989 and it was a year and a half after the crash, people weren't even talking about it anymore. Market already corrected. It was already up. It was fine. That was part of something in the past. This period now will be in the past soon. And anyone that didn't stay invested or get invested during the time is going to look back on it and say, oh God, now I'll have to wait for the market to go down again before I get invested, be paralyzed. Anyway, what is there anything that you see, you know, a shining light on top of the hill, or something really dark and scary out there that you see coming up as possibly the next trend, or something we all should be thinking about that no one else is?
So no one is saying that 10-year treasury yields are going to go to 2.5%. Have not heard that forecast. So I think we're kind of unique in that bucket. So you want to be in fixed income. You want to have a 60-40 style portfolio and ladder it over a period of time. We're in a digital era. This is not going to go away. Technology is evolving faster and faster. I mean, I think we've passed Moore's law in technology. I'm concerned about the mega cap stocks that went up a lot. If we look at the stocks that they call FANG, which are like Meta, Apple, Amazon, Netflix, Google, they make up almost 50% of the NASDAQ 100 index. News, it was reported in the Wall Street Journal the other day, Apple and Microsoft now represent the highest weighting in the history of the S&P 500. When you start seeing stuff like that, run. Now, I'm not telling you to sell your Apple, your Googles, your Microsoft, but understand that these stocks have to come down in terms of the percentage of the index. We do this flip-flop on Wall Street, but that doesn't mean you don't want to own tech. I love semiconductors. You think about everything we use. I'm on my laptop. We all have our phone next to us. You get in your car. I have 3 different ways to use technology in my car. My washer and dryer have chips. I can connect my phone to my refrigerator, to my dishwasher, to my ovens. You know, the list goes on and on. The cloud, we're storing everything on the cloud. Well, you need chips for where we're storing it. We're mining for crypto. Those are machines. Those need chips. So I'm very comfortable owning semiconductors. I'm comfortable owning software. So I think you need to have exposure to tech. You just want to be very selective where you have tech. Very big in infrastructure, right? We learned we had too much overseas. We're onshoring now. That's all infrastructure build. Building out our grid, our electric grid, because we're going to use more and more electricity, right? As we're going more electric cars is just one part of it. So I like the industrial space. Right now, I like the utilities and energy. Can't leave out energy. What surprised me, and I wrote this in our year ahead, if you look at the projected demand of all sources of energy, of course, coal is going down, electricity is going up, even nuclear is slightly going up. But when I looked at crude oil, I expected to see it rolling over because we're doing wind and solar and electric and natural gas. I expected to see the demand to start really rolling over for energy, and found even going out to 2050, it barely budges. So as much as you keep hearing about we don't want to use fossil fuels, we don't have anything to replace this thing called crude oil. Unless we have a major technological advancement, and then you got to figure out how to get it into the economy, it ain't going to happen. So energy is still I think is a sector that you want to be in. And listen, I'm not as smart as Warren Buffett, and he just tripled down on Occidental Petroleum.
Right.
So I think, right now energy is getting hit because we're pricing in a recession. The market is pricing in a recession. You saw crude, hit down into the 60s. If we go into a recession, crude may go down into the $50, $60 range. And yes, that will put some pressure on energy stocks. But based on where we are in supply and demand, that's going to come back up again. So I still think energy is a very important pocket. Really avoiding consumer discretionary kind of names, right? Especially if you're going to go into recession, especially if you're going to see employment go up. And we're seeing a lot of layoffs being announced now. So discretionary spending is not going to be as strong. Although we see pockets that are strong, like home builders. The consumer, at least for now, wants to travel and, hotels. But the consumer part of the market, I'm not as bullish on.
All the different trinkets and stuff and gadgets that we bought during the lockdowns, and it's all, coming full circle where people don't need them as much. Anymore.
Exactly.
Perhaps. Yeah. I would agree with that. And on energy, it's interesting. We've had a really severe winter here in California, and no one should feel sorry for us because we generally have very mild, beautiful winters, and it's just not a big deal. We've had over like 100 inches of rain. Our grid has been tested with multiple power outages, and we had friends working in the office, or I had a friend working in the office here last week because he couldn't get internet going for the whole week. And you realize how isolated and how paralyzed you are if you're trying to do business from home. Like we couldn't be doing this call right now if you had a power outage, or we did. In this era, but at the same time, government mandates are saying, hey, we're going to be completely alternative energy by 2035 or 2040 with certain things. We're not ready for that. That's more of talk. It's where we want to go.
We're trying to move. We're trying to move that way.
There, and also you've got the rest of the world that's still operating in a way that they're not going to be able to be there, and they're growing. And so the demand for fossil fuels and green energy, I think, are both going to be good growth vehicles over time. And innovation is going to probably be the disruptor of that somewhere between now and the next.
Well, the blockchain is the biggest disruptor. That's the next level of the internet. In fact, our first podcast, I think, is getting released this afternoon. It might already be out. And I interviewed the CEO of Jenny Johnson from Franklin Templeton, and she's very tech savvy because she ran their tech division for a number of years. And she says Bitcoin is the biggest distraction of the greatest disruption in business today, and that's blockchain. Blockchain's a real technology, and I even asked her in the podcast, I said, Jenny, can you see, securities, bond stocks trading on the blockchain? She says, oh, they're already working on it. There's a lot going on. I mean, people up in the Silicon Valley are probably much more aware of the evolution of technology, but there is a real movement to going from Web 2.0 to Web 3.0, and that's blockchain. Bitcoin will be there, but there's a lot more to that whole cycle. And I'm really excited about a lot of the evolution in technology that's happening, and where we're going to be in the next 5 years is going to be very different than where we are today.
And you're very astute, I know, in that, having you went to I don't even remember the name of it, but the university in London and whatnot, that is the one specialty in this subject. And like you're saying, I think you're right where. Or I think she was right where, your Bitcoin is, you're looking at the tree versus the forest is blockchain. And I think that the derivatives market is already settling using blockchain, if I'm not mistaken. There's certain parts
there's certain parts that aren't.
Yeah, instantaneous settlement. And if we get there with stocks and bonds, you don't have to wait certain days. It's done instantaneously, and then the recorder is on the ledger of the blockchain. And I see eventually, when you sell a house, you don't need to go to the title company and wait in line and pay all these different fees. It's basically recorded on the blockchain, and it's done right there. Right.
Now, we were talking about commercial real estate and the private market. Well, they're going to tokenize real estate. It's already started, but you will be able to buy fractional shares of real estate on chain.
Right.
It's mind-blowing where we're going.
Right. And eventually the Fed is going to have, their piece of it too. And so it doesn't
we'll have
necessarily which coin is going to be the right coin. It'll be dollar-based, and
the central bank will have its own coin.
Right. And so why would you go anywhere else and use it for, being involved with something that's, for the most part, is used for nefarious reasons.
Right. I do want to point out, since we're in this conversation, because you're seeing a lot in terms of regulators right now, right? Coming out, they just served a Wells notice to Coinbase. They just did something with Binance. But I've said the SEC has allowed a futures on Bitcoin. It is trading. That was validation to me that the SEC has acknowledged that Bitcoin is real. And it's really important to understand that Bitcoin is the cash of the internet. It's the electronic payment. Unlike anything we've ever had in history, because it's not backed by the full faith of a government. It's not backed by gold. And I also want to say it's the most volatile asset I've ever seen in my lifetime. It goes up and down 80% in a flash. It's not for the faint of heart. But the other coins that you hear about really are not cash or coins. They're technology. They're technology being built on the blockchain. So, but they're using coins or tokens as a way for people to invest in them, but they're really not true currency. And I think we need a whole education for investors to understand what all of this is. And this is the early days, just like it was in the late 1990s and 2000s. We really don't know who the winners and the losers are going to be. Most of us in the business feel that Bitcoin will be around in some kind of form. Ethereum, which is the next largest on chain, is a software, and many programmers are building on that platform, but we don't know if that is going to be the platform. So it's very, very early days with a lot of volatility.
Right, and the real winners, we probably don't even know what their names are yet. So
that is very possible. Very possible.
Well, Marianne, I really, really appreciate your time today. And I hope all of our clients and friends that have tuned in have gained from this as I have. I wish you well. And if there's anything that comes to mind after our conversation that you want to add to it, we'll be sure to put it into the information when we send out this video.
That's awesome. Thank you so much for having me. And I look forward to maybe doing another one with you and your clients again.
You bet. And for all of you that tuned in, thank you very much for tuning into the Quorum Forum today. Our guest speaker was Marianne Bartels, and have a very nice day.